So today we are going to study chapter 10, and that is valuing a derivative. And that is the method is one period binomial model. So here it is only one period. If we have two periods, then we will have a binomial tree, or we can go even three period or four period. So depending upon the need of the accuracy. So moving from one period to two period is not difficult. It is a repetition of the same. But just that the nodal point needs to be changed. It becomes after one. Right now we have zero nodal point. Then after one period, it will be nodal period one. So that's how it extends and tree is formed. We will discuss these learning of modules. So they are learning modules means what we will learn in this chapter. So the first thing is that the one period binomial model values contingent claims, which are options, yeah, not the forward and futures. So for swaps we had seen, and for forwards also we had seen the valuation that it is the risk-free rate, and for futures also it was the risk-free rate. And F0t is equal to S0 times 1 plus R to the power T. That was the valuation of the forward price after depending upon the period. So T. But here we don't have that simple, and the reason being that these are contingent claims. So if the market goes up, then call becomes in the money and buyer of the call exercises. And but if it goes down, the call becomes out of the money and put is in the money. So the holder of the put exercises. So because of that, we need this model, binomial model for valuing contingent claims. Then what does it combine? This binomial model combines an option with the underlying asset to create a risk-free portfolio. So the risk-free portfolio is whether the market goes up or down, you will have the same portfolio value. Then only it is a risk-free portfolio value. Otherwise, if the values differ, then they will be different. Now, how to make that risk-free portfolio, that we will discuss. And then it tells us that we can have that portfolio by having a hedge. And the hedged portfolio must earn the prevailing risk-free rate of return. Because this market is risk-free, or we are using this concept of no arbitrage, where this risk-free rate is used. So the hedge portfolio must earn the risk-free return. Like when we value this S02, S0 and F0T, current spot price and future forward price, we use risk-free rate. So everywhere, whenever we are using no arbitrage risk-free formula, then the portfolio must earn only risk-free rate. Otherwise, if it doesn't earn risk-free rate, like less or more, then the arbitrageurs will enter. Now, so valuing the derivative, of course, it requires discounting the expected payoff. So we will do this. You will understand when we will do with number means, well, you know the discounting very well by now, that everything which we are valuing, future value calculating today is discounted. And then another thing is that since we are doing with risk free, and our hedge ratio must be risk neutral, so that whether the market goes up or down, the value of the portfolio is equal. So that requires that doesn't matter what is happening in the actual world. Since we are valuing using risk-free, neutral probabilities, so actual probabilities don't impact the price of options. Now,
Sir, can you explain that statement, sir? Neither the actual probabilities of underlying price increases or decreases, nor the expected return are required to price an option.
Yes. So when we are pricing an option like call or put option, then this actual probabilities are useless. We calculate risk neutral probability and we use only that probabilities. So actual probabilities won't affect the price of the call or the underlying rate, what is and not the expected rate return on the underlying are required to price on option. Means this underlying is giving 5% return on investment or 10%. It is not even needed. So actual probabilities are not needed because we are calculating risk neutral probability. Actual probabilities will not be risk neutral. They have occurred, but then they contain error terms. Risk neutral probabilities are theoretical probabilities and they don't contain error terms because they have this, they are supposed to earn only risk-free rate. Actual probabilities will earn more than risk-free rate or even less than risk-free rate. So that's why neither the actual probabilities of underlying price increases or decreases, nor the expected return of underlying are required to price an option. So you will know this when we are actually doing it, and then we go down. So we will solve these after the class because it is using some of the concepts which are in the class.
So primarily the difference is the actual probability is after the event has occurred, whereas this risk free is like we are predicting this would be the probability before the event occurs.
Yes,
Yes.
yeah. So actual probability, yes, that will happen after, yes. So once the price has been set, the probability will be different, of course, from risk neutral probability.
Ah, yes, sir. Yes, sir.
Yeah, but then since we have to do arbitrage free pricing, so the risk neutral probabilities are used. Okay. So the law of one price states that if payoffs from any two assets means what are the payoffs? Means discounted value. If we have future cash returns are identical in all possible scenarios, then the value of these two assets must be identical today. Means whenever they have cash flows which are identical, then their value must be identical today also. So forward commitments are symmetric and payoffs are predetermined price in the future. And our this one is contingent, so options are contingent. Anyway, it doesn't matter much here. So the binomial model is a common tool used to determine the no arbitrage value of an option. So since it determines no arbitrage value of the option. So how do we do that? So the simplicity of this model is really very simple. And we only need to make an assumption about the magnitude of potential upward or downward price changes of the underlying, means volatility. So upward or downward, how much does it go up, how much does it come down? So that's the magnitude of uh, potential upward and downward, and that is called volatility in simple terms. So we had this no price of the underlying, current price of the underlying, then exercise price, time to maturity, risk-free rate, and volatility. These five were the principal factors for determining the price of option. Then, of course, we had income and cost of holding an underlying. So that one is adjusted after this price has been determined. Or well, that is easy to adjust, means we just calculate the present value and deduct it if it is income for call calculation and add it if it is for put calculation. Same with the cost. Means cost we add for calculating uh, call option and we deduct it for calculating put option. So this binomial model is not very difficult and you will really like it or you will learn it soon. So any stock can go up or down. Okay. So if it goes up, then that is called in period 1. So right now it is period 0. So S0 is the price of the stock. And in period 1, it can go up. Then S1 will be greater than 0. And if it goes down, sorry, S1U will be U for up, will be greater than S0, then the ratio will be greater than 1. And if it goes down, then S1D will be less than S0, and S1D by S0 is less than 1. So, how do we calculate the return? We calculate the return or ratio. This is only ratio, not return. If ratio is RU, R is actually the return, but okay. So RU is a return when it goes up, and RD is the return when it goes down. So RU is S1U by S0. Though it is fraction, it should be, if we deduct -1, then it will give us percentage return. So this is the ratio of S1 to S0. Now, why do we need this? The RU minus RD will give us the spread or volatility per unit. So that's why we need, and in absolute terms, S1U minus S1D, that will give us the volatility in real numbers. And RU and RD, they give us the ratio of the volatility with respect to S0. Okay, so let's go down further. And so far, these are simple, that if it goes up or down. So this is the graph of that. Means when S1 is up. So here is S0. S0 is here, this part. And if it goes up, then we are reaching here. And if it goes down, we are reaching here. So this is very much normal. Now, the probability. So how to calculate, why it is useful. So how we are pricing this. So the method is that we are calculating this R. So let's have this in a real example. So consider a 1-year European call with an exercise price of 100. The underlying current price is 80. And the underlying price is 80, yes. And what will be happen? In one period corresponds to the one times expiration. Okay, no. I am putting the phone away. So this one is underlying price is 100. Sorry, underlying price is 80 right now.
Sir, this is similar to the like heads or tails experiment that we have seen in probabilities.
Yes. Yeah, exactly. It is heads or tail experiment.
So we
like
either have two. We only have two outcomes, and the sum of both outcomes should add to one.
Yeah.
And if it extends beyond one trial, it will be like a binomial tree.
Yes.
Yes.
Otherwise, it is Bernoulli distribution.
Bernoulli. Oh yes. Sir.
Bernoulli is only heads and tail, but we have more than we have binomial distribution. So it is exactly that. And the exercise price. So what does it tell? Exercise price is 100. Now, if it goes up from 80, then how much will it go? It will go to 110. And if it goes down, then how much will it go down? To 60. So from 80 to 60, if it is going down, means RD is equal to S0 by S1 by S0 means 0.75. So RD becomes like that. And what is RU? 110 by 80, so which is 1.375. So that is how this is expected. This is just expected. It is not that it is risk neutral or not, that we don't know yet. It is just expected.
Sir, so this is the actual probability.
Actual probability means actual probability means the market is expecting. So you can say it actual probability. It is not theoretical probability. Okay. Or it is not risk neutral probability, telling that okay, it will go up. Some people are expecting that this the stock price will go up to 110. So to answer your question, I would say yes, it is actual probability that they are expecting.
Yes. So
Okay.
then the risk-free probability is like the von Neumann Morgensen theorem. That one also.
Okay, so that becomes the part of yeah, statistics.
Uh,
Von Morgensen from, yes,
yes, sir.
he
We
talked.
saw that in risk neutrality while gambler, non-gambler. That thing we saw also.
Yes,
Uh,
but we are not going to be that difficult here.
oh, okay, sir.
Yeah,
Okay.
it is going to be very simple here.
Okay,
So
sir.
at T0, what is the call option value? C0, and it is available in the market. You can see it anywhere in the market that call option right now at this price for this exercise is this minimum. At T1, the call option will be C1 if the market goes up, and so that will be C1U, and if market goes down, then it will be C1D. So, and what about the stock? If it goes up, this becomes S1U. And obviously, if it goes down, then it will be S1D. So, we need to calculate the risk neutrality. So, we need to calculate the hedge ratio. Okay. So, what will be the price of the call C1U? So, C1U prices means we are expecting that this will go to 110 and exercise price is 100. So payoff is 10. If it really goes 110, so payoff is 10. We don't know
Okay.
what is the probability. Yeah. So C1U will be 10. And if it goes to 60, then the call will be out of money and its
Zero.
payoff will be 0. So C1D payoff is 0. It is almost always there. That this one is 0 because it is below exercise price. So what we are going to do now? So in order to calculate risk neutral portfolio, what we will do? So in this, so only C0 is known right now, and which may be determined by using replication of no R.
C0 is not known, sir.
The only unknown value is when? Oh, we have to calculate C0. Okay, yes.
Yes.
Yeah, we have to calculate C0 right now. So C0 is unknown. Oh, what is known? This S0 is known. And what else is known? S0 exercise price is also known. X is also known. The free rate is also known. So let's see what we do. Now C0 is unknown, sorry, yeah, which may be determined using a replication of no arbitrage pricing. So how do we replicate it? Okay. So that is the value of both the option and its underlying asset in each future scenario may be used to construct a risk-free portfolio. For example, at T0, we sell the call option at price C0 and purchase H units of underlying assets. So how do we calculate this? How do we know H units of underlying assets? That is what H is the hedge ratio. So we have a portfolio, C0 can be replicated, and we can calculate the current portfolio by having a hedge ratio. So how do we calculate? Denoting the value of portfolio V, we have the following equation. So V0 at current price is H into S0 minus C0. So this one is our stock. And what percentage of stock we are calculating H we have to find too, and to make it risk neutral or risk free portfolio. So
Sir, H is percentage or the number of units, sir?
hedge is the percentage of a number of units. Yes, exactly. So that whether the market goes up or down, this value of portfolio will remain the same in period one. So in period one, what will happen? S1 will be either going up or it will be going down. So when we have V1U, the portfolio same, H is the same, S1U minus C1U, because call will also be new. Okay. So what will be the call here? The call will be, so this one is actually our portfolio value. It has not calculated call. The portfolio value is H times RU that we had calculated the ratio. So S1 is RU times S0. That is what he has substituted. This RU times S0 is actually this S1. He substituted that S1. And then minus the call value is of course max of S1U minus X. And for down, again, we have this part is S times RD times S0 minus max of S1D minus X. Here, this is most likely to be 0 because the call will be out of money. C1D is normally 0. So let's see. So V0 represents current portfolio value, V1 U period 1 when the market has gone up, and V1D when market has gone down. So we must choose H so that V1U is equal to V1D. That is what this hedge ratio is. Means whether market goes up or down, our portfolio value will remain the same. So what we are doing, up move from S0 to S1U, then what will happen? The portfolio has gone up from 100 to 110. Okay. So RD means ratio is 1.375, which is 110 divided by 80. And so what will be the value of C1? Obviously, we had calculated that it was 10. Payoff was 10, we had already calculated. So C1U is 10 and C1D was 0. That we had calculated. So C1D is here 0. So in order to calculate hedge ratio, this is the formula. C1U minus C1D divided by S1U minus S1D. So our C1U was 10 and C1D was 0. So upper it will be 10 and S1U was 110. And D was how much? 60. So 110 minus 60 is 50. So our H should be 0.20. Means 20% of the asset S0 will be purchased to have this and when the call will be sold. So that is what it is. So the relationship between call and underlying is negative for hedging, because if the underlying price goes up, the call price also goes up. So since they are having what I would say two different sides, no, means we have to make them neutral, discrete neutral. So if both are increasing, means if we buy one and sell the other, then only they will be 0. They will equal to 0. So that's why in order to make them discrete, if call is bought, then underlying HS0 will be sold. Or when call is sold, HS0 will be bought to make our portfolio risk neutral. Okay, so H star we calculated.
Sir, can
Yeah.
you explain that 20% once again, sir? I'm
Oh,
confused.
this one is very easy. It is already given here also.
The value
20
I'm able to get, sir. But like, what is the meaning of the 20%?
C1U. Okay, so let's come here. C1U is, we had calculated that if the S1 goes up, means if the market goes up, means S0 goes up in period 1. So it tells that it becomes 110.
Yes,
Here is the question, no? We had this question here. Here we had this question. Okay. The binomial model specifies the possible values of the underlying asset in 1 year, where the option value is a known function of value of the underlying asset. So underlying asset, how it changes. We assume that S1D is less than X, which is less than S1U. So exercise price was 100, and what he is assuming is between the value of the underlying two scenarios. For example, S1D is equal to 60. It is telling that when the market goes down, right now S0 is 80. Here it is given, no? The
yes, sir.
current spot price, the price of the stock is 80. So if it goes down, it will go down and become 60. If it goes up, then it will be 110.
Yes, sir.
Yeah, so this one is clear. So that is what information was used here, that S1U is 110 and S1D is 16. Now, if S1D is 60 and exercise price is 100, so what will be the value of the call? Means
Zero.
that will be 7. It will be 0, no payoff.
Zero. Oh, yes, sir. Yeah.
And what will be the value of call in this case?
10.
10. Very good.
Yes.
So C1U is 10 and C1D is 0.
Yes, sir. Yeah.
That's clear?
That's clear. Yes, sir.
Okay. So that is what it has been used here. So here it is C1U minus C1D is equal to 10.
10. Yes, sir. Yeah.
And S1U was 110.
Ah, yes, sir.
And how much was S1D?
Yeah, 60.
60. So
Yes,
110 minus 60 is
50.
50.
Yeah.
So 10 divided by 50.
Ah, yes, sir.
Yeah, so 10 divided by 50,
50 is 20. Yes, sir.
yeah, is equal to 0.2. Yeah. So
Yes, sir.
that is what is the hedge ratio or H star. Yeah. So that's what it was. Hedge star, we got this H. Yeah. So this one H star is the hedge ratio. So what does it mean? That if we buy a call, we must sell 0.2 of our security to have risk neutral, means to have the same value. So if call goes up, we lose on because we sold the underlying. So we lose that much, exactly that much amount on the underlying, and so net result is 0. Or if we sell call, means if we sell 5 calls, then we must buy one security, so that if the call becomes what? Uh, so if the call becomes in the money and we have bought one security, we have bought 5 calls, means all the 5 calls become in the money, so we get money, but we sold the underlying, so we lost on the underlying, because when the price goes up and we have sold, means we lost it.
So, in this case, if we hedge it like that, then ultimately we'll make the returns like a risk-free bond, right?
Yes, we make it sound like this for yes.
Oh,
That's
so
what is
here they
called
are
risk.
replicating a risk-free bonds returns.
Yeah, so we are making it risk neutral.
Okay,
So
okay,
any risk neutral asset will get risk free return.
okay, okay.
So that you already
So
calculated.
here the objective is finally so that the person does not take any risks. So he doesn't gain any positive impact of the risk also.
No, the person should take risk. It is that it is arbitrage free. Arbitragers don't get the opportunity. So means the purpose is to calculate the arbitrage free price of the call. That is the purpose.
Oh, sir, but if it's the risk-free bond rate, then he's also making only the risk-free rate, right? Like he's not
Yes,
making beyond the risk-free.
yes. So in that case, yeah, if you are buying risk free rate, then yes, you are not taking any risk.
Ah, yes, sir.
Yes, that is what it's
Like he's protected from the loss as well as he's making only the risk-free
risk
return.
free rate. Yes.
Uh,
So you won't, you are deprived of gains as well.
yes, sir.
Both the things work. So, so we have this. Now let's calculate the value. Okay, so he says that V1U. How much was V1U? So it tells that we can use either portfolio value. So what will be the V1 value? The portfolio value V0 was H times S0 minus C0.
Yes, sir.
That was the portfolio. So at V1 means if the portfolio becomes up, yeah, so we have this portfolio to start with, we bought. So V1 is, where is the formula of the portfolio? Let's see, it has already calculated. It has already, okay, let's see. What does it tell? Now we had discussed the hedge portfolio. Where was it? It was, I think, yes, here.
Here, sir.
Here it was the portfolio. So V1 is, so V0 is HS0 minus C0. V1U will be H S1U minus C1U. That will be our portfolio,
Yes.
and which is equal to H times RU is the, well, it has already been calculated ratio. S1 by S0 is RU times S0. So let's see how it has worked here. So our H is already known. Now, up move from S0 to S1 by RU. So how much is this? How does it? So total portfolio value is V1U is equal to HS1U minus C1U. This one is correct. So
Yes, sir.
V1U, so what is HS1U? So S1 became 110 and our H was 0.20 and minus C1U was 10. That's correct.
Yes, sir.
So how much is the value? 22 minus 10, which is equal to 12.
Well, yeah.
So if the market went up, our portfolio value became 20, became 12.
Well,
Now what if it goes down? It should also be 12. So let's see. When the portfolio value goes down, so this V1D is equal to H times S1D minus C1D. So C1D is 0. This
yes, sir.
C1D is 0. So, and what is S1? S1 was 60. So
Yes, sir.
60 times 20 is equal to 12. So this 12 and this 12 are equal. Yeah. So
Yes, sir.
whether, so that's the advantage of having calculating H or risk neutral hedge ratio. So then we are now safe from risk, whether portfolio goes up or down, we don't care. We will get 12. Now, what will be the value today? So let's go down. The portfolio value is the same, and we can use either portfolio value to value the derivative. Means we will use these values to calculate our C0 today. So how we will calculate? The return is V1 by V0 or VD by V0 must equal plus the risk-free rate. So this must, since our portfolio, both V1U and V1D are equal, so the return should be this V1U by V0 should be the same return, and that will be risk-free rate. So how is it? How we are going to
So,
do
sir,
that?
why is it given that it's 1 plus the risk-free rate?
1 plus risk-free rate is because it is ratio. No, V1 by V0 will be 1 plus risk-free rate because it will tell 1.02. It will, because it is ratio. So our risk-free return is 2%.
Oh,
So
okay.
yeah.
Sir, but
Actually,
V1D
our
by
language is not very good.
uh,
It should be the return, not it should be the ratio. Here, yeah,
sir, but V1U by V0 would be greater than
one.
1, and V1D by V0 will be less than 1, no, sir.
Yes, it will be less than
So,
one, but no, it won't be less than one. Why will it be less than one? Because V1D and V1 you are equal, no? We calculated 12, no?
oh, V1D. Okay, 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 yes, sir.
Both are equal.
So that then the whole ratio will be equal, no, sir.
Yeah, both ratios are equal. And it is
Uh,
telling that this 12 is containing V0 times 1 plus R to the power t.
oh,
That is what it
okay,
is telling.
okay,
So
okay, okay.
V0 times 1 plus R to the power t is equal to V1. U or V1, it doesn't matter because both are equal.
Okay, okay, okay.
Yeah. So we have V1. And so what will be V0? V0 is HS0 minus C0. So V1 by 1 plus R. And what was our R? Let's go down. R we were given, no? So R was how much? R was 5%. R was given 5% in the question. So since R was 5%, so V0 would be V0. So V0 is 12 divided by 1.05 to the power minus 1. So whatever it is. So how do we get call price? Our equation was how to calculate C0. Yeah. So we had this equation, no? Let me type it here. This V0. V0 was equal to H times S0, S0 minus
C0.
C0. Yes. So C0 is equal to hence C0 is, or hence C0 is equal to what?
H into S0 minus
HS0,
V0.
yeah, HS0, HS0 minus V0. That's it. Okay. So HS0 minus, and this one is our V0. So V0 is V1 times 1 plus R to the power minus 1. So S0
Should it not be to the power of minus T?
minus T, yeah, but here T
Uh,
is 1 year, no? It should be minus
oh,
T.
one period only. Okay, okay.
Yeah,
Okay.
it is one, it is 1 year.
One. Okay, okay.
It is
In
just
this
one
question,
year.
it's 1 year. Okay, okay, sir.
Yeah, in this question is 1 year. So that's why he calculated H was 0.2, S0 is 80. This you remember. And 12 is the V1 discounted by 1.05 to the power minus 1. So 16 minus 11.43. So V0 is 11.43. So call is equal to 4.4 euro 57 cents. That is the price of the call. So that's how it is calculated, and we will calculate many, so don't get scared.
Yes.
This is one method, and there is another method as well. So we will calculate ourselves here, yeah.
So,
And
like yesterday, we are just rewriting the same equation in
yeah,
different terms. Oh, okay.
yeah. So it
Okay.
is like that only. It will be
Okay.
like yesterday only,
Okay.
just doing here and there. Though this equation will be less used, we will have a better equation which is shorter than this. We will use that. But this is for understanding. So
Yes, sir.
let's calculate this part. High test capital. Okay, you read this question and we will calculate ourselves without looking at the answer. So let me put it down so that what steps we will do, I will help you in that.
Yes.
Okay.
Uh, Highest Capital believes that a particular non-dividend paying stock is currently trading at $50 and is considering the sale of 1 year European call option at an exercise price of 55. Answer the following questions. If the stock price is expected to either go up or down by 20% over the next year, what price should Hitest expect to receive for the sold call option? Assume a risk-free rate of 5%.
Okay. So let's answer one.
Yes, sir.
Now, so what will be S1?
Uh, sir,
What is S0 now? So we have, let me
0
write,
is 50, sir.
S0 is 50. So
Yes,
let me type it, yeah. So S0 is equal to 50. Hmm.
yes,
So
sir.
S1 is how much? S1 U upper, yeah.
S1
S1
U is
U is equal to how much?
60, sir.
60.
Mm.
And how much? 60 or 65? What are you saying? Answer.
Goes up or down by 20%.
20%. It will be 60. Yeah.
Yes, sir.
S1 U is equal to 60 and S1 D is equal to
40.
40. Very good. Now, what will be the C1 when what is the exercise price?
55.
X. So X is equal to 55.
Yes, sir.
Okay. So what will be C1 U? C1 U is equal to, so it's so C1 U. Okay. So C1 U is equal to what? Yeah. How much will it be? So S1 U is 60.
Yes, sir.
So C1 U will be 60 minus 55.
Yes, sir.
So it will be 5. Hmm. And what will be C1D?
C1D would be 0, sir.
0. Very good. So our H star. Hmm. H star is here. Yeah? H star. This one is equal to what? C1U minus,
minus C1D divided by S1U minus S1D.
so that is equal to 5 divided by
20.
divided by 20. So
1.25.
0.25 is equal to 0.25. Okay. Now we have to, what is V0? V0 is equal to H S0 minus C0.
Yes, sir.
So V1 will be what? V1 is
V1 would
equal
be,
to
sir,
H,
V1U is,
V1U, yes, sorry. V1U. V1U, well, since U and D both will be equal, so that I had forgotten.
okay, okay,
V1U is
okay.
equal to what?
So that will be
HS1.
0.25
Yeah,
into,
let's calculate it. Yeah,
I,
so let's write the formula first. HS1 minus C1. Yeah, that is what we will write. V1U. So this one is equal to 0.25 times V1 was 60.
60.
Yeah, and minus C1U. So I should write it here C1U. Okay. So which is n minus C1U. Okay. We don't know what will be C1U. C1U. So oh no, we know C1U. Sorry. C1U is 5, no? Minus 5. You see?
Yes, sir.
C1 is equal to 5. So this is equal to how much?
10, sir.
10. Okay. So V1D should also be 10.
10, yes, sir.
Did we calculate or I leave it?
I already calculated, sir.
You already calculated. So
Yes.
V1D is also 10.
Yes,
Let's
sir.
forget
Both
it.
are,
Okay. Now, what will be V0 at risk-free rate of 5%? So what will be V0?
sir, V0 would be V1 by 1 plus R to the power of minus T.
Yeah, to the power minus
Plus T. Sir. Yes, sir, minus T. V1 divided by 1 plus R to the power of T. Which is,
yeah, divided by what about T, and how much is T here?
T is 1 year European.
Oh,
1
1 year,
year.
okay.
1 year.
So it is 1. So how
10,
much is V0?
10
10
by
divided.
1.0. Yes, sir.
So V10 is how much?
9.52.
9.52 or 53?
9.523.
523, 9.523, so 52 is the better word, yeah?
Yes, sir.
9.52. So, how to calculate C0? So, we had this formula, no? C0 is equal to
C0 HS0 minus V0.
HS0,
minus V0.
HS0, sorry, H times S0 minus V0. Yeah?
Yes, sir.
So, V0, sorry. So, how much is HS0?
0.25 into 50.
0.25 into 50 means
12.5.
12.5. 12.5, no?
Yes, sir. 12.5.
12.5 minus
9.52.
9.52. 9.52, which is
Yes, sir.
equal to
2.977.
2.98.
977. Okay, sir.
Yeah,
2.98. Yes, sir.
2.98. You have two digits, that's it.
Yes, sir.
So we calculate. Not difficult.
No, just have to remember the formula.
Huh?
We
Yeah,
just have
you
to
just
remember
have
the
to
formula.
not even remember the formula, means you just have to calculate H, and yeah, and then you can easily buy.
One formula I have to remember, sir. then rearrange again and again.
Yeah, which formula you need to remember?
The
V0.
V0 is equal to HS0 minus C0.
Yes, this you need to remember. And if you know this, then you know V1, V1D both. Okay. And then H also you can calculate. No, that also you need to remember.
Yes,
C1
sir.
minus C0
C1 minus C0.
by S1
That's
minus.
conceptually you can easily remember that.
Yeah. So we calculated call price C0 is equal to 2.98. Did we get this answer? Oh, it is very long. Very long. 2.98 here is the answer. Yes. So we got the answer here 2.98. Okay. Easy. Now, what else? What do you, A negative hedge ratio implies that both the derivative and the underlying are purchased. That will be for put. So here we had positive hedge ratio. In this case, since the derivative is sold, the underlying is purchased. But what if it is negative? Then both will be purchased. Means in the case of put, we will have to purchase put as well as the underlying. Yeah, we will have to purchase both. In the call, we purchase call, then sell the underlying, or when we purchase the underlying at the with hedge ratio, we sell the call. Or when we, so that's how. But for put, it goes in same direction both ways. Okay. Now,
Sir, can you repeat that, sir?
it is telling that we had to be risk neutral. No, means the portfolio value change should be zero.
Yes, sir.
So
No.
if we are selling the call,
Yes,
then we must buy
by the underlying.
underlying times how much underlying hedge
H
ratio.
into underlying. Yes, yes,
Yeah,
sir.
H times underlying.
Yes, sir.
But for put, we have to buy both, because in put what happens when the price goes down, then only put comes in the money.
Yes, sir.
So we have to use protective put. Means we are buying the underlying as well as the put. So in that case, the hedge ratio will be negative. So we calculated hedge ratio 0.2, and here we had calculated how much 0.25.
Yes,
That
sir.
was positive, but when there is negative hedge ratio, in case we calculated and found minus 0.25, it means we are calculating the price of the put, and in that case we will have this buy the underlying times H and also buy the put. That is what it's telling. So, and it is also telling that this ratio H is important. 4:1 in this case means H is 0.25, means you buy 4 calls and sell 1 underlying. So that is what it is. 4:1 units is maintained. Okay, let's go and see question number 2. It is clear so far?
Yes, sir. So far it's clear.
We solved it only a small. The book took a lot longer space. Yeah, about 3 times of what we used. Anyway, now B.
How would the call option price change if the stock price were expected to go up or down by 40% over the next year?
Okay, so 40% means how much? Okay, let me copy this and paste it, and then we will change only the numbers. Everything else is control A and control C, and I paste it here, control V. Okay, S0 is same. What will be this S1U?
It will be 70, sir.
70. And this one will be 30.
30. Yes.
Okay. Now, this one next is 55. No change.
Yes,
Okay. What is C1U?
C1U would be 70 minus 50, 20.
50, 55, no. So,
Oh, sorry, 70 minus 55. Yes, sir.
so 15.
15. Okay.
Yeah, C1 is equal and C1D is equal to 0.
0. Yes, sir.
That's for sure. Now, what will be the H? So C1 minus C1D is 15.
Yes, sir.
15 divided by how much is the spread? 70 minus 30, which is equal to 40. Yeah.
Yes, sir.
So how much does this happen? Our head is how much?
0.375.
0.375. 375. Okay. So V0 is this now. V1. How much is V1? 0.375 times V1U 70. Yeah. 0.375 times 70 and minus 15. So how much is that?
Yes, sir. 11.25.
This one is 11.25.
25.
Is it?
Yes, sir.
That's okay, 11.25. Now 11.25. Okay, here is 5. Okay. And then how much is V0 then?
Sir, V0 will be same now, sir.
Huh? This is
Oh,
V1
no, no,
zero,
V0. Okay, okay, okay. V0 is
discounted by 5%.
okay, okay. 375 into it's not
It's
minus,
like
not
10 point something.
minus.
What happened?
Oh, 1 second, sir. I
Yeah.
copied the wrong one.
Okay. 11 divided by 1 plus R to the 1.05. 11 divided by 1.05. That's it.
11.25.
How much? 11.25. Oh, so yeah,
11.25.
11.25 divided by 1.05.
10.71.
10.71.
71.
Okay. Now, C0 is HS0 minus V0. So HS0 is how much? 0.375 into 70. How much is that?
375 to 70. 26.25.
26.25 and minus how much is this?
10.71.
10.71. So how much is that?
Minus 15.54.
15.5. Oh my God, the call increased so much. 15.54. Okay. So you see the impact of volatility means when
Yes.
volatility increases, and how much did it increase? Earlier the volatility was 20 and it became 40. So if volatility increases, the price of the option increased from how much? 2.98 to
15.4.
15.54. Okay. So let's see, did we calculate correctly or did we make any mistake? The change seems too much to me. So this one is correct. V0 is also correct. Oh, here is the problem. We have to HS0, no? So S0 is how much? S0 is
Yes,
not
sir.
showing the
0.375 into 70, sir.
0.35. No, that
Oh,
is
into 50. Into 50, sir. Oh,
50.
into 50.
Calculate this. This S0. So 0.25 times 50. 0.25 times
It's 8.04.
8 point.
04.
Okay. Now it looks correct. 8.04 because to me it looked too much. That well, it only doubled, and 15 was too much because from 3. So now it is more than double, about 3 and then 8. So more than double, but that was rather 5 times.
Yes.
So that's why I was wondering that we made some mistake. Okay, so our calculation is this much 8.04. No, let's
Yes.
see. Okay, let's go. No, very good. 8.04. So we calculated correctly here 8.04. Okay, very
Yes.
good. Not difficult. Life is easy. Looks like you learned this also.
Yes, sir.
Okay. Now let's see what is question number 3.
Uh, if fighters had a more optimistic outlook on the future stock price, how would the expected call option price change?
So they had a more optimistic. They had a more optimistic. Will it have any impact of outlook?
No, sir, because that's the
No.
definition of this
Sorry, the definition.
binomial. Yes, sir.
Yeah, so the price would remain the same. Okay, very good. Question number 4.
What would be the price of a 1 year put option at an exercise price of 55 if the stock price were expected to change by 20% and 40%?
Okay, so we can calculate put option also using this formula, or if you want to go for shortcut, then let's do yesterday's formula, put call parity.
Yes,
So
sir.
what was put call parity? Yeah,
Put call
then
parity was
P0
uh,
plus,
sir,
yeah, put call parity was P0 plus S0.
P0 plus S0 is equal to C0 plus present value of X.
C0 plus present value of exercise price, yeah,
Yes, yes.
PVX. Okay. So what is X here?
X is 50, 55, sir.
Hmm? We have
55.
55. No, okay.
Uh,
So present value, no. So 55 is X. So what is its
uh,
present
uh,
value? So I will write P0 is equal to, yeah. So present value of X plus C0. So C0 is how much? 2.98, no? C0 is
uh,
for 20%.
yes,
So
sir.
we have
Okay.
2.98. So 2.98 plus what is X? And present value of X.
Oh, 55, no, sir. So
55 divided by 1.05,
52.3.
52.3, and minus S0. S0 is 50.
Yes, sir.
Yeah. So what does it come out?
Uh,
Five. Yeah. 5.01. No, it is 30. No. So 5.28.
5.36.
5.36.
36. Yes, sir.
No. Okay. You are saying 5.36.
Yes, sir. Okay.
Okay. Let's see. How did you calculate that? 2.3 plus 2.98. So 2.3 plus 2.9, it should be 5.38.
Oh, sorry, sir. 5.28, sir. 5.28.
Yeah, 28, yes.
5.28, yes.
5.28 is the correct answer, yes. That's correct. So let's see. Okay, and let's calculate 40% as well.
Yes.
So what will be P0 at when it is 40? So again, I put it down, and then we will match both together. This one was how much? 8.04. Yeah, 8.04 plus. What will be this? This
Uh,
one present value is, this will remain the same.
Same. Yes, sir.
Yeah, 52.30. Okay, and minus
50.
min-
10.34, sir.
minus 50. So which is equal to how much?
10.34.
10.34. Okay. So let's see. 5.28 and 10.34. Yeah, 5.36 and 10.42. Okay, that is just the discounting thing. So we calculated 5.38 and 10.42. So did we, where is the problem? It is rounding difference, that's it. 10.34, 32.30. Did we make any? 10.34, 5.28. So how much is that? 5.28, and the book is calculating 5.3836. So 8 cents. Where is the difference? This one is correct. This one is correct. This one. Okay. So here is the difference. That's it. Because our formula is correct,
Yes.
and here also. So formula is correct. It is just rounding. Okay. You see, our formula is correct, no?
Yes, sir.
Yeah, our formula, this is the formula we use. Yeah. So this doesn't matter. Okay. What is your discounted value of 55?
Yes, sir. Like if I take 4 decimal places, it is coming to be 5.36. It is just your decimal place.
Or if you are going to take it for 4 decimal places,
Yes, sir. Then it is coming 5.3609.
5.309. Okay, so let
Uh,
me correct it then. Yeah.
yes, sir.
So
36.
5.36. Okay.
So similarly for the other one, it will be
How much? 8 cents more. How much is that coming? Means this 32.30 shouldn't be the correct thing. Yeah.
10.42.
Okay. So let me put it straight. Okay. 10.42. So 12 cents more. Yeah. 10.42. So then it will be how much? 10.46. 10.46. Yeah.
Yes, sir.
Okay. That's fine. So let's go down. So really not difficult.
Yes, sir.
You learned it. Okay. Now answer these questions then. If you learned it, then yes. What is the solution of Yes. Okay. I did it.
Determine the correct answers to fill in the blanks. To price a contingent claim such as an option, a model for the dash of the underlying asset is needed due to the dash nature of the contracts. A model for the
This one is easy, no? This part, the second part is definitely easy due to contingent nature, no?
contingent nature. Yes, sir.
So this one is easy.
Sir, to price a contingent claim such as an option, a model for the uh,
A model for,
price of the future price of the underlying asset.
yeah,
Uh,
future price of the underlying asset, yeah, like S1. Yes, so future price of the underlying asset, yeah, future price. But it should only work. A future price of the underlying asset, like we needed S1. Future price of the underlying asset needed due to the contingent nature
binomial nature.
or non-linear also we can write. Let's see what is the answer here. A model for the asymmetric nature. Yeah, contingent is asymmetric. So both have the same meaning.
Describe the main difference between pricing a contingent claim and pricing a forward commitment.
Okay, so
Sir,
yeah,
symmetric, asymmetric. Sir.
asymmetric, yes. Yes. Hmm.
If a one period binomial model is used to price an at the money put option, which of the following statement is most accurate? The option will in the money if price moves up out of the money. At the money, sir. So C only, no, sir.
At the money if the price moves up or down. No. Mhm. And what does put tell you? Yesterday, you use yesterday's knowledge. So if one period binomial model is used to price, and add the money put option.
So it will be in the it will be out of the money when the price moves up.
Yes, so B is the correct answer because it will be out of the money. The correct answer is B. Yes.
Sir, but how do we think that we should know yesterday's chapter for this?
Huh? How do we know? No,
Yes, sir.
there you will not know which chapter to use.
Uh,
That means you have to know all the chapters. So add the money if the price moved up or down. No, if the price moved up, then the put will be out of money, and down, then it will be in the money. So statement C is not the correct definition of put.
Okay, sir. Okay.
Yeah. And in the money, this is also not correct. It will be out of the money.
Yes, sir.
When
It will be in the money when the price comes down.
Yes, and it will be in the money when the price comes down. Yes, so out of the money if the price goes up.
Oh, sir.
Yeah, so this one is correct. B. Okay. Question number 4.
Explain how increasing the gross return or decreasing the down return in one period binomial would influence the price of a call and put option.
So if we increase, like we did 40%, 20% to 40%. So what had happened? Means volatility increases.
Volatility increases. Yes.
So then what will happen to the price of call and put?
They increase. Sir.
They increase. Very good. Both increase.
Both increase.
Yes. Therefore, if either the price of the underlying asset should fall else, then the price of both call and put option will increase. Yes. So
Sir, but if the gross ratio is negative, then
gross ratio negative means what?
sorry, if the hedge ratio is negative.
Hedge ratio, no, hedge ratio will never be negative. Hedge ratio, yes. Hedge ratio will be negative, then you buy put. Yes. Yeah, but it is telling not about sign. It is telling increasing or decreasing.
Decreasing return. Okay.
Yes. So it is not whatever be the sign. Okay. Question number 5.
A put option on a non-dividend paying stock has an exercise price of 21 and 6 months left to maturity. The current stock price is 20, and an investor believes that the stock price in 6 months will be either 10% higher or lower. Describe how the investor can construct a perfectly hedged portfolio using the put option and its underlying stock.
Okay, means he will buy the put and buy the underlying.
Yes, sir.
So we have to describe now how the investor can construct a perfectly hedged portfolio using the put option. Okay, so he will buy the underlying and he will buy the put is known. Now we need to calculate H0. So how do H? So H will be P1 U minus P1 D, no? And then divided by S1 U minus S1 D. So,
Oh, okay. Oh.
yes. So a put option on the non-dividend has an exercise price of 21 and 6 months left to maturity. The current stock price is 20. And an investor believes that the stock price in 6 month time will be either 10% up. So it will be 22. S1U is 22 and S1D is 18. So we have here 22 minus 18, which is 4. And what will be put value? So when it is 22, put value is 0. And when it is 18, the put value will be 21. No, so minus 3.
3.
3. 21 minus 3. So 3 by 4 means 75%. So he will buy the put and he will buy 0.75 of the underlying. Yeah, is that correct?
Both he will buy, yes. Sir, but for that, the gross ratio needs to be negative, no, sir? But for that, the gross ratio needs to be, oh yeah, 0 minus 3. Okay, okay. It's
Yeah,
negative.
it will be 0 minus 3.
Oh, yes, sir.
So it will be minus 3.
Yes, sir.
Okay.
So he will buy put and 0.75 of the underlying.
Yes.
Or he will buy underlying and 0.75 of the put.
No, if he buys one underlying, then he will buy 1.33 put.
Oh, it's, oh, the, okay, okay. Yes, sir.
Yeah, you see the point? If he buys one underlying, then he will have to buy 1.33. Let's see. 22, 18, so 0, 3. So H is minus 0.75. So to create a receipt portfolio, we can buy the put option and buy 0.75 unit of the underlying. Okay. So that is what we discussed. Okay. Let's see the.
What will the value of the hedged portfolio be in a scenario that the stock price rises and scenario that the stock price falls?
Assume the risk-free rate is 4%.
4%.
Okay, so what will be the value of the hedged portfolio? What was the hedged portfolio our V0? So let me type it. So what was our hedged portfolio? Our portfolio was by put, one put. So P0 plus how much? 0.75 S0. That is what our portfolio was, and we don't know the value of P0. Sorry, it will be S0. So S0. So we know for sure that it will be more than 15 because 0.75 times 20 is 15. So 15 plus P0. So how to calculate P0? That again we will have to
Use the that
the
put
formula.
call parity.
Yes, we will have to calculate that. So do you want to calculate or do you want to move forward?
Sir, we'll calculate.
You want to calculate? Okay, let's calculate them. So let's come here and copy this formula. Where was that?
Sir, but here we don't have the C0 now, sir. So
No,
here we
we
don't have.
don't have. We can calculate C0.
Oh, okay.
We can calculate C0 and then we can calculate P0 as well from that. So let's calculate whatever you want to do, we can do. So let's copy which one, top one, and then we will calculate. So what is this one? And the entire thing. Control A, then Control C, and let's go down. Because we are using what we have learned so far. Later on, you will find an easier formula. But okay, let me paste it here. So I paste it here, Control V. So S0 is 20. S1U is 22. S1D is 18 and X is equal to 21. And then C1U will be what? If the
We
price,
don't need C1 also. Like we can for V1 we can substitute V1 is equal to H into S1U plus P1U. Like, because you are talking only put options, right? So
what
we
will
can
be the value of hedge portfolio? No, yeah. So hedge portfolio,
so
okay,
V1 is
yeah.
equal to H
We don't need
into
to do that.
S1U plus
Okay,
P1U.
yes. So let's do that. So V0 is so P0. So this will be plus P0. So I will have to let me move this down. Let me copy this and come down. Control C, and we will put what happened. I wanted to copy that only, and I'm coming down here. I'm pasting here for P0. Okay. So I don't need to put this. Let me change this here only. Limit. I couldn't delete it. Okay. So what you are saying that we need to calculate V0. So what is S0? This one we knew, but we didn't know P0 value, no?
Oh, sir, I'm telling you should calculate V1U. So for that V1U is H into S1 minus P1U, right?
Yes. So if you want to calculate P1U, then yeah. So P1U was 3, P1U was 0,
P1U was
and
0.
P1D
So
was 3. That
yes.
we had calculated.
Yes.
So S0, S1, U, okay. So instead of C1U, we calculate P1U. Yeah, that is what it is. P1U is equal to 0. Yeah, P1U is equal to 0. Okay. And then P1D is equal to 3. P1D is equal to 3. Okay, so H is already 0.75. So here we have this 0.75
So
and
it's
I
minus 0.7.
minus 0.75. Okay, yes, so we have this H is equal to minus 0.75. And so S0 is 20. I had already written. S1U 21. I have also, why did I repeat this here? Let me delete this. Let me delete. So why did I write this? I don't know. Probably it got copied and pasted. Now, this one, the V0, yes. So we need to calculate only V0. Okay. So V0 is S0 plus P0 plus. But then again, we don't have the value of P0, no? Plus, yeah, plus P0. So that was the
So then
problem.
this formula also would change, sir. Like V1U is equal to H into S1U plus P1U or minus P1U.
Yeah, this we will have to, yes, this we will have to change. So let's calculate this. V1U is equal to HS1 minus, it will be plus P1. It will be plus P1U. Okay. So how much is this? HS1 15 plus P1U was how much?
P1
Yes,
was 0.
15. Oh, so it is 15 only, yeah. So P1 was 0, so this one is equal to P1U.
Sir, how is it? H is minus 0.75, sir.
H is minus 0.75, yeah.
Yes.
So you
And
are purchasing it. No, H is only used for purchasing. You are not selling it. So you want to say that mathematically I should write minus 15.
no, sir. How did you get 15, sir?
Oh, 20 times 0.75, no?
It should be
HS1 is,
22, no, sir. 22 into 0.75.
no. Oh, okay, yeah, 22 it is, yes. So it will be 17 point, how much? 16.5.
16.5. Minus 16.5.
Minus 16.5. But we are purchasing, so okay, it will be minus 16.5. Doesn't matter. Okay, minus 16.5, yes. And then what will be V0? So discount it.
So, but I'm not. Uh, I calculated V1D. V1D is not equal to minus 16.5. It's minus 13.5. Like they are not equal.
They are not equal, then we are making mistake. That's why I was going to calculate C0 and from that basis calculate P0. Because that's why I was going to do that.
Oh, yes. Right.
Yeah, that first calculate C0 and then from that calculate P0 and then calculate V0.
So, but by definition, they should be equal, right?
They should be equal. The problem is that they move in the same direction. No. So in that case,
So
means
one
we
is
have,
plus, the other should be minus.
yes. So that
Sir,
was
so if I change the formula to uh, H, so V1D is equal to H S1D minus P1D, then I'm getting them to be equal.
then you are getting both equal.
Yes, sir. Instead of plus, if I do
Okay.
it minus, then I'm getting it.
But so long as if you are getting both equal, then it is minus 16.5. No.
Ah, yes, sir. It's minus 16.5. Yes, sir.
Okay. So what will be V0 then? So V0 will be discount this by 5%. And I delete the, oh, sorry. So
Minus 16.5.
how much does that come? Minus 16.5. That needs to be discounted.
So rate is what?
Yeah, how much it is coming? This
What is
rate is
the
4%.
2%? Oh.
Yeah, rate is 4%. So 16.5 divided by 1.04. It should be 15 point something.
So it's also for 6 months, right? So
Yeah. Okay. Yeah. So more than 16 years. So it will be not 1.02. Yes. 1.04 to the power half. That is what you will have to do. It will be something 16 point something.
1 second.
Yeah.
Sir, getting something wrong. So,
You are getting wrong answer.
sir, I'm getting 161.7.
16 point.
No, I got 161.7.
Oh, no, there is a problem.
Uh,
You will have to divide it by 1.02 to get the rough value. So let's see what is the answer. Yeah, it is 16.18.
Sir, it's 1.02 or 1.04, sir.
No,
It's
it is for 6
oh.
months. So it will be 1.02. So minus 16.5 divided by 1.02.
Oh. 16.176, sir.
16.1.7 or 1.8. Go to
176.
Yeah, so it is 1.8. Yes. So this one is 16.18. V0 is 16. What is happening? Am I not here? Yeah, I am here. Yes. So V0 is equal to 16.18. Okay. So V0 is this divided by, should I write the formula? 16.50 divided by within bracket 1.02. 1.02, yes. which is equal to 16.18. Okay, so our answer matches the book's answer. That is where they are calculating 16.18. So V0 is here 16.18 V0. Now, what is the price of the put option?
So that is V0 minus H into S naught.
V0 minus,
H into S naught.
yes. So, very good. So, how to, let's calculate that as well. All it is easy. So, C. Answer to, oh, I will write it separately. Yes. So what is the answer? P0. P0 is equal to HS0. So HS0 minus V0. So which is equal to HS0 is how much? Which is equal to?
1 second. H is.
Oh, sorry, it will be opposite here. Because that is for call no. So yeah, V0 minus HS0. Yes, V0 minus HS0. So which is equal to 15, yeah? Yes.
V0 is. What was the
V0
V0?
is 16.18, which is equal to 16.18 minus 15, which is equal to
1.1.
1.18. Yes, 1.18. Okay, so this matched to yes, 1.18. That's fine. Now answer question number 6. What does it tell? Yeah.
When the dash applies, the rate of return on all risk-free assets should equal the
Risk-free rate, yeah.
when the no arbitrage.
When the no arbitrage applies, yeah, the rate of return on all the spaces should be equal to risk-free rate. Yes.
Yes.
Or the law of one price.
Law of one price.
When the law of one price applies, yes. Okay. So risk neutrality, we already did that, but then we will have this smaller formula that how to calculate this risk neutrality. So using this not C1 minus C1U minus C1D, no, not using that. We first calculated hedge ratio and then we calculated the price of the call and the put. This one is that risk neutral probability of going up and down. So let's see what does that tell. We may generalize the relationship between an options value and that of the hedged portfolio from equation 5. It is not equation 5, I think it is equation 7 or whatever, of the prior lesson using the example of a call option C0. C0 is equal to pi times C1U plus 1 minus pi times C1D divided by 1 plus R to the power T. So how to calculate pi? Pi is the risk neutral probability. So the value of the call option today C0 is computed as the expected value of the option at expiration, C1U and C1Do. And so that is the expected, means multiply by probability, risk neutral probability.
Into, okay, that's P1 minus P, that concept.
Yeah, P times 1 minus P, yes, that's it.
Okay.
So, you know the statistics, so it is very easy to calculate. The total probability is equal to 1. So, how to compute the risk neutral probability, and it is very easy. So, we knew that what is RD and RU. So, RU was like when we call S1, U by S0 is RU, and S1D by S0 is RD. So, just pi is 1 plus R minus RD divided by RU minus RD. That is the generalized formula of what we did for C1 minus C1U minus C1D divided by S1U minus S1D. So it is in ratio. Again, it is S1. S1 is R times S0. So S0 has been taken out common. So let's go down and see how easy it is. So here is the substituting the details from our earlier example where this S0 was 110, RU S0 was 110, RD S0 was 60, and S0 was 80, X 100. So how did we get RU? 110 divided by 80, which was 1.375.
1.375. Yes.
Yeah, you had already calculated.
Yes. Sir.
And this 0.75 also
0.75.
60 you had calculated. So 1 plus R minus RD is 0.75 divided by RU minus RD. So risk neutral probability is 0.48.
Yes. Sir.
So we calculate the C0. So 0.48 times C1U was how much? 5. Yeah, C1U was, I think it was 10. 0.48 times 10 plus 0.52, and of course it was,
Zero. No.
yeah. So that will be gone. So this gives us $4.57. So how did we get 0.48 into 10 is 480 and discounted that by 1 plus R. So we get 4.57. That is what we had calculated using C1 minus C1U minus C1D. So this formula is easier. C0 is equal to pi. Pi is what? Risk neutral probability times C1U. We had easily calculated. C1D we had easily calculated, and RU and RD both we had calculated very easily. So let's go and solve this question. What does it tell? Read it.
Sir, so is the answer differing or it's the same, sir?
It is the same answer.
Oh,
4.57.
4.57.
Yeah, it should be. Let's see. Here is 4.57. No, it should be the same. I would have to go much up. A little bit. It was not this question. It was it this question? 10. I think it was it this question? 60, yeah. 60. No, it was not this question. That was question earlier.
This is the first question, sir. This one.
First question, yes.
Ah.
So
It was this one only, sir.
this one only.
Scroll down.
So I will go down now. So how much? Yeah, 4.57.
Okay. Okay.
Yeah.
So they're just giving another formula.
Another
like
method.
Other things are given.
And that is much easier, much smaller. We don't need to do H. We don't need to calculate H. Okay.
Oh, okay, sir. Okay.
Yeah. So that will be simpler. So let's say, let's have this. Okay. Read question 1. High test capital.
Revisiting example 1, we can now explore the option price using risk neutral pricing. Answer the following questions. What is the risk neutral probability of an up and down move in the one period described in example 1?
Okay, so let's calculate pi. So what was the formula of pi risk neutral probability? So I don't
1
know
plus R minus RD by RU minus RD.
Yes, is equal to 1 plus R minus RD. RD. So I will write this RD divided by
RU
minus RD. Okay. So this will be in parenthesis. The top one doesn't have to be. Okay, the top one also has to be in parenthesis. Otherwise, computer will divide only RD. Okay, so let's calculate this. How much do we get? So pi is equal to 1.
R is 0.04.
R is 0.04 in this case. Okay. So 1.04 minus.
RD is 1.375, right?
No. RD is less.
Lesser one. 0.75.
Exam.
It is given. It is given above, sir. Like if you scroll up, it's given. Yes, sir.
So high test capital. Okay, let's go up.
This page itself is given, sir.
It will be on this page.
Yes,
it is on this page only.
Because they have explained the example there. Yes, sir. Here, sir.
Here.
Scroll down, so like
Scroll
Down,
down.
down, down. Here.
Oh,
RD is 0.75.
is it for high test capital? I think it is for someone other.
It's the same question, sir. 110, 80. Same question.
Sure, okay. Let me
Yes, sir.
see. So RD is 0.75. No, let me see. Answer is it is 80, not 0.75. It is different. RD is 80. So RD is this high test capital is another question. Let's go on. This one was high test capital, you say. Yeah, this high test capital. So up by 20% and down by 20%. Yeah, the stock price is expected either to go up by 20% or down by 20%. That is what this is telling. So RD is 0.8 and RU is 1.2. So here we have RD is equal to minus 0.8 divided by 0.4. Simply means
Sir, it
1.2.
is 1 point. It's 5% in that question, sir. So
Okay, this 1.05. Okay, that's fine. So how much does that come? 0.25 by 0.4, which is equal to
0.625.
0.625. Okay, 0.625. This is our risk neutral probability. Then what does it tell? Demonstrate how this risk neutral probability can be used to arrive at the no arbitrage price of the call option. So let's calculate C0.
C0 is equal to pi into C1U plus 1 minus pi into C1D
Yes,
divided by 1 plus R to the power of T.
pi into C1 U, okay, minus uh,
Plus,
plus sorry, yeah, plus within bracket 1 minus pi times C1D, no? Times C1D divided by 1
1
plus
plus R to the power of T.
1 plus
So here T is what?
yeah, so I am not writing 1, yeah, to the power 1. Since I typed, so let me write that too. So the formula is complete. Okay, so pi is here 0.628. Yes, so I bring it down. So this one is equal to C0 is equal to 0.625 times what? How much was this?
C1U C1 was
C1U was how much?
15, 15,
15 or 20%. Let's go and see what was the exercise price. Let's go.
5, sir. The C1 was 5.
Huh?
5.
5.
Yes, sir.
So, okay, it was only 5, no?
Mm.
Okay, you already saw it.
I think I'm correct.
Okay, you think, okay, let's see. 50, yeah, 5. European call option and exercise price of 55. So X is 55 and this becomes 60. So 60 minus 55 is 5. And display rate is 5%. Okay, so let's move on. Okay, so what was the page? That was page 230. So this one is 5 times 5 and that one is 0. So 0, C1D is 0. So no need to even do that. Divided by 1.05.
2.976.
Huh?
2.976.
2.98. Okay,
Yes.
so that's correct. We matched it.
Oh,
Okay,
yes, sir. The same answer was. Yes.
the same answer. So this was for question number 2. And question number 3.
So what would be the value of the European put option on the same stock with the same exercise price and expiration date?
What would be the okay put? So let's calculate put as well.
That we
So
have already calculated, no, sir. So it's the same thing.
same thing. So no need to calculate, or should we calculate using this formula?
Oh, you have same formula for this, or
Of course, you have same formula for this.
Okay.
So let's use this formula. So let's calculate P0. P0 is equal to pi times put 1. Yeah. So that will be 0. Because when the price goes up, then it will be the first part is 0. And 1 minus pi means 0.375 times what was the put value? Let's go up. And then only we can calculate, no? So why not to put it 235, 235, no, 235, and let me say, I need to go a bit up more. So what would be the value of put? Okay. So if it goes down, exercise price is 55. So put value will be 15, no? P1D. Means when the price goes down, then it will be 55 minus 40. So it will be 50. And then discount that. So we will have that. So this times 15 and divided by 1.05. Okay, do this calculation. How much do you get?
5.35.
5.35.
35.
Okay, we calculated that. And what is the confirm that the call equation price computed in question 2 and the put price both justify the put call parity. Okay, so if we match the answer, then we know that we can calculate. So we confirm. Okay, let's confirm ourselves. So P0 plus S0. So P0 is how much? Let me go down a bit. P0 is 60. How much is it? 5.35.
5.35.
So P0 is 5.35. And how much was S0? 50.
50. Yes.
Plus 50 is equal to C0. C0 is 2.98 and
Yes.
plus our present value of 55. How much is that?
Oh, 1 second.
Risk-free rate is 5%. So 55.
55.36.
How much?
55.36.
50 point.
Oh, 55.36. Total value is the same, sir.
Okay, so what is the value of this discounted value?
55 divided by
55 by 1.05.
52.380.
52.338. Okay. So we get equal to both, no?
Yes,
Which is equal to 55.35. 55.35.
that's satisfying.
Yeah, that's satisfying. So means our answer is correct.
Correct. Yes.
Let's see what the book. So book says 0.735 is the 1 minus pi and pi. 1 is correct. What about 2? Right? Plus, yeah, Yogi.
Yes, sir. You were lost for a minute, sir.
Yeah, that's why I rejoined. Yeah. Read question number 1.
Sir, screen is not shared.
Oh, Hmm. Okay, so read question number one.
Which of the following factors influences the value of an option when using a binomial model? The risk-free rate of return, the level of investors' risk aversion, the probability of an upward price movement. Risk-free rate of return.
Yeah, very simple question.
If an underlying asset price in a one period binomial can increase by 15 or decrease by 10%, and the prevailing risk-free rate is 4%, what is the risk-neutral probability of an asset pricing decrease?
Okay, so the central probability of an asset price decrease.
Yes.
What is the risk neutral probability of an asset pricing? Why it is asking decreasing? The underlying asset price, because it is the risk of decrease. So 1 minus pi. Is it asking that? If the underlying asset price in one period binomial model can increase by 15% or decrease
It
by,
is asking the formula of pi only, no?
yeah, it is asking the formula of pi only, yes. So what is the formula? So we will have 1.15 and in the bottom it will be 0.90. So we will have denominator 0.25 and what will be in the numerator? So what is the risk-free rate? 4%.
4%.
So 1.05 minus 0.9. Yeah, because it
It
decreases.
is 0.56.
So 0.56.
Total value is 0.56.
0.56. Very good. Pi is 0.56, no?
Yes, sir. Pi is 1.
Okay. Pi is equal to 0.56.
Sir, then I think they are asking 1 minus pi.
1 minus pi decrease. Hmm.
Yes, that would be
What
the
is the
mean
risk
of.
neutrality of asset pricing decrease? Yeah, yes. So 1 minus pi, 0.44. So 1 minus pi is whatever they ask, they will give you the option. 1 minus pi
Okay.
is equal to 0.44. So let's see. Okay, the risk neutrality of downward is 0.44. Okay. So question number 3.
Which of the following best describes the risk neutral pricing interpretation of one period binomial option pricing formula? The risk neutral expected payoff discounted risk free rate. B, sir.
The risk neutral expected payoff discounted at the risk neutral expected payoff discount. Yeah, very good. B is the correct answer. Yes, that is what we did. Means
Definition.
yeah, by definition. Okay.
If a call option is trading at a higher price than the implied binomial model, investors can earn a return in excess of the risk-free rate by buying at the
No,
risk-free rate.
at the risk rate you borrow. So borrowing at the
Oh,
risk.
borrowing at the risk-free rate,
And what
then
will you do to the call? Buy or sell? What is
buy
the
the
price?
call.
Huh?
Buy the call.
Buy the call. Why? If a call option is trading at a higher price, means you will sell the call. It is trading at a higher price. No, so whatever is trading at higher price, you sell it. No.
You sell it, buy low, sell high. Okay, yes, sir.
Yeah. So
So buy the
buy low,
underlying,
sell
sell
high.
the call. Okay, okay.
Yeah. So you will sell the call.
Sell the
Yes.
call, buy the underlying by borrowing at risk-free rate and sell the call. Oh, yes, sir.
Yeah, very good. So you will sell the call. So first of all, you see whether it is high or not and fill that part. Then
Yes.
the other you can do easily.
Yes, sir.
Yeah. So okay. So you will sell the call and then buy the underlying and borrow at the risk-free rate. So what does it tell? Selling the call. Yeah, here it is, and buying this. So yeah, selling the call and buying the underlying. And what is the borrowing? Yes, borrowing means whenever there is a risk-free, either you borrow or lend. Only thing you have to
Yes,
do
sir.
that.
Yes,
That
sir.
only you can use one of the two words. So let's go down. Let's calculate.
A
Okay.
stock price is currently 8,000 yen. At the end of 1 month, when its options expire, the stock price goes up by 5 or down by 15. If the risk-free rate is minus 0.2 for the period, what is the value of a put option at the strike price of 7950?
So let's calculate pi first.
Yes, sir.
Yeah. So let me type. What will be pi? Pi is equal to 1 plus R. So 1 plus R. So here R is negative. So 1 minus R is 0.002. 0.002
Sir,
and
it is point two. Oh, yes, yes, sir.
0.2%.
Okay, okay.
0.002.
Point zero
No?
zero two. Oh, yes, sir.
Yes. And minus RD. So how much is RD? Down by 15%. So 0.85. Yeah.
Yes, sir.
This entire thing divided by how much? Point up by 5% and down means 0.2. Yeah. That's how we will calculate pi. So how much does it come? Yes. Pi is equal to how much?
One second.
How much did you get?
Calculating, sir. 1 minus
Okay.
0.02 minus
0.002, not 0.02. 1 minus 0.002 and minus 0.85
divided by,
divided by
sir, 0.74.
0.74. Okay, very good. So 0.74. So we calculate 0.74. So what we have to calculate? We have to
The
calculate
price
C.
of put option,
You put
P.
option, huh?
What is the value of the put option? P0.
P0. Okay. So forget this 0.74. So P0 is equal to 0.26 times, because that will be 0. So put only here. Then how much? What is the exercise price? Stock currently 8,000 and strike price is 7,950. So what will be the value?
50.
Means payoff.
P1D is 50.
Means if it goes down by 15% means how much does it happen? 12,000 down. So 68. So 1150. 0.26 times 1150. Yeah. Zero, it will be 0.26 times 1150. And this divided by, it is only for 1 month. So what to divide? Just one. Divide means it is negative, no? So 1 plus R. So it will be even more than that. So how much will it will be 0.999 divided by point, because 1 month it will be 0.998. That is what I am roughly calculating. 0.98 is 0.02%. No, not even 0.999. It will be this. Okay. So what is the value?
Sir, 1 second. 0.26 into 195, 299, 299 divided by
0.26 times 1150. How much is that?
299.
299. So B is the correct answer. Because if it will be more than, slightly more than 299. So B is the correct answer. 299.60. Okay. Yes, 299.60 is the correct answer. So we got it correctly. Yeah. Okay. Now that's it. End of the chapter. Okay. Let's solve this question number 1.
Private bank, Kleinhardt KGA, a private wealth manager in Munich, has a number of clients with a large holdings in German fintech firm Sparcoin AG. Kleinhardt's analyst is concerned about a drop in Sparcoin's share price in the next year and is recommending to clients that they consider purchasing a 1-year put with an exercise price of £100. The spot price is 105.25 and it pays no dividends. The risk-free rate is 0.37%. The Kleinhardt analyst estimates a 50-50 chance that the price of Sparcoin will either increase by 12% or decline by 10% at the put option's expiration date. Which of the following statements best describes the no arbitrage option price implied by this assumption?
Okay.
Hmm.
You don't need to calculate anything.
Oh. Since there is a 50% chance that the stock will fall to 94.70, there is a 50-50%, 50 chance of a 5.27 payout upon exercise and no arbitrage put is therefore worth 2.64.
Definitely wrong, because we don't use 50%. No, we cannot divide it by 2. We have to calculate the pi, risk neutral probability. So A is definitely wrong.
Is definitely wrong. Yes, sir.
Yes.
Since there is a 50% chance that the stock will fall to 94.73, there is a 50-50 chance of a 527 payout upon exercise, and given the risk neutral probability of 0.47, the no arbitrage put price is 2.48. So you have to calculate it.
Okay, no, you don't need to calculate. It's 0.47, believe it. Let's go to option C, because that will be not 0.47 times, this will be 0. 0.47 times 0, and plus 1 minus 0.47 means 0.37 times this 5.27 divided by, yeah, C should be the correct answer.
Sir, where are you getting this 5.27, sir? You have to calculate.
Which one? 5.27? No,
Ah.
it is 105.25. No, here. And it is 100 is the exercise price.
Yes, sir.
So if exercise price is 100, and how much is it going down? Yeah, since there is a 50 that the stock will fall. It is giving no 10% fall.
Okay. Yes, sir.
It has given no here.
Yes, sir.
Yeah, here 10% fall. So you don't have to calculate much.
Okay, sir. Then C is correct.
C is correct. Yes. So answer to one is definitely C. Because for this will be put will be 0. When the price goes up, the put is 0. Payoff. So definitely 0.47 won't be multiplied. It will be 1 minus 0.47 multiplied. Okay.
If clients believe that observe that 1 year put option with a 100 exercise price is trading at 250, that the following statement best describes how clients would take advantage of this to earn a risk-free return greater than 0.37 over the year.
So let's calculate the put price. Since we got the power, we have already calculated 2.78. Yeah. So we know the value of put, which is 2.78. So how will he take advantage?
Client should purchase the put option and also purchase approximately 0.23 shares per option to match the hedge ratio.
So what is happening? Is this put trading at a discount, or cheap or expensive?
Sir, it is discount, sir.
Discount. So we will buy put.
You will buy the put, yes.
And if you buy put, we buy the underlying as
We
well.
buy plain as well. Yes.
Okay, so now the answer should be clear. Okay, which one is the correct? Just see.
Client should purchase the put option and purchase 50% of the underlying shares. No, B is wrong. Client should purchase put option and purchase 47% of the underlying shares to match the risk.
So what is the hedge ratio?
Hedge ratio here is
That means hedge ratio will be P1 minus P2. So 0. So hedge ratio will be how much? C1 minus, so it goes, let's calculate hedge ratio. So hedge ratio 150, 100.
P1U minus
Yeah, P1U minus P1D. So here
P1U
P1D
is
will be,
0.
yeah.
P1D is 2.78. So minus 2.78.
No, P1D is not 2.78. P1D is 5.27. P1U is 0 and P1D is 5.27. No, that is what will happen.
Sir, but option C has given put price is 2.78.
Put price, no, that is put price. That is the expected value of P1U and P1D. No, so how do we calculate hedge ratio? C1U minus C1D divided by S1U minus
S1D.
S1D. So this one we will use this one 5. What was that? 5.27. So we will use this value. So 5.27 to calculate hedge ratio divided by how much will it go? Up by 12% and down by 10%. So how much will that be? What is the price? Right now price is 105.25. So make it 12%. So 5.27 divided by how much will that go?
Sir, up would go to
105.25 times, how much?
117.88.
117. Okay, so 5.4,
Yeah, 117.
5 point, how much? 5.27. 5.27 divided by 117 point, how much?
88.
88 minus down
94.73.
94.73.
73.
Okay, so what is the value? It
So
is
that is
equal to,
point 2276.
H star is equal to, so which is equal to 0.2276 means 0.23.
Yes, sir.
Okay,
So I think option A has.
option A, yes. Option A is option A is the correct answer, yes. So option A, I should put this here. Hmm. Option A, okay. Go ahead, next question number 3.
If risk-free investments, if risk-free investments yielded a higher return over the next year, which of the following statements best describe how this would affect the no arbitrage value of the put option on fair coin shares? As a solely function of probably degree of share price increase or decrease upon expiration. I think this.
R is always in the formula.
Oh, yes.
R is always whether we calculate pi or whether we calculate the what other thing. No,
So it's in the denominator. So if R increases, the whole value will decrease.
the whole value
So
will decrease. That's for sure,
C,
and
C,
it
C.
will also increase this probability. So yes, risk neutral. It will because it is, for risk neutral probability also we use the formula. No,
Yes, sir. Yes.
means pi. So we put 1 by r no in the denominator.
Yes, sir. Yes, sir. So C, sir, because
C is the correct answer. Yes.
decrease the value.
Okay. Question 4.
The expected percentage increase and decrease in Sparkcoin share price were to double. Which of the following is the closest estimate of the 1 year put option with an exercise price of 100?
So we can calculate it.
Yes, sir.
Yeah. So how double? So 12 to 24%. So what would be pi? Let's calculate pi first. So pi is equal to pi is equal to what? 1 plus r. So 1 plus 0.04. No. What was the r here?
Yes, sir. 104.
0.04 minus, now it becomes 20% down. So means that becomes 0.8.
Here R was 2% or 4%, sir. I'm not sure.
Okay, let's go and see what was the R. Risk-free rate. Risk-free rate. Where is that risk-free? Oh, risk-free rate 0.37%. Okay, so it is 0.0037, not 4%. 1 plus 0.0037. 1 plus 0.0037 minus RD. RD will be 20%, no, 0.8. Because here it is falling by 10%, no, where it drop, drop in the, where is that? Yeah, decline by 10% and increase by 12%. So RD will be 0.8 because it will double, so 20%, so 0.8. Let's calculate it. Minus 0.8 divided by how much? 1.24, because that was 12%, minus 0.8. So what is the value?
1.0037.
0.2, yeah. 0.2037.
0.164.
Huh?
0.164.
Okay, divided by 0.44. So this one is equal to how much? So which is equal to 0.
Oh, sir, 1 second. Wrong, sir. 1.24 minus 0.8.
Yeah, so that will be 0.44.
1.0037 minus 0.8. Divided by 1.24 minus 0.462.
0.462 means 0.46. Okay, so we got pi. Now, 1 minus pi will be 0.4. So P0 is equal to, let's forget because 1 is 0.46 times is 0, so it is 0. And 0.54 times, what will be the exercise price? What was that? What was exercise price? Exercise price was 100, no? Exercise price 100.
100
And
minus
it falls down to how much? Calculate 80% of this.
80% of
105.25.
80% of
105.25. How much is that?
84.2.
84.2. Okay. So 100 minus 84.2 is equal to 15.8. Yeah.
Yes, sir.
So 54 minus 15.8 divided by, is it for 1 year? So 1.0037, which is actually equal to 1. So how much does that come? This is equal to what? 15.8 times 0.54.
Total is 8.5.
8.5.
Option B, sir.
Option B. Okay. So let's put our calculation here. So that, so option B. Okay. So let's match the answers. And 1 is C, 2 is A, and 3 is C. So C, A, C, B. C, A, C, B. Very good. So you got 100%.
Yes.
Now, this book is over. And congratulations that we finished this book by the not even the middle of August, and looks like you are learning very well. So that's it. Now I stop the recording and
Sir,
then.
can you send this book to me? So, like, you've saved all the calculations. So,
Oh,
can
you
you send?
want this
Yeah.
copy? Okay, okay,
Yes.
yeah, I can send you. No, no issue. Definitely, I will send you this.
Can you send it now, sir? Like,
I will
otherwise.
send you right now.
Okay.
Right now, I will send you right now. Within on WhatsApp.